Coming up in today's show, stocks finish a little lower ahead of the big jobs report tomorrow, jobless claims rise slightly, an update on the Treasury market, and what's going on with oil, and why Coca-Cola and Pepsi were slammed down today. Welcome back to the Click Capital Daily Market Show, everybody. Hope you're doing well this Thursday, and it was a pretty flat day on Wall Street. Market's kind of coiling up for that big non-farm payrolls report tomorrow. We did see a little bit of strength in healthcare and financials, and consumer staples was a losing sector. We actually saw Coke and Pepsi come off both around 5%, and stick with me because I'll get into those two later on. But first, let's go over everything else that is happening out there today. So we just had weekly jobless claims come in, with 207,000 people applying for unemployment benefits last week. That was a bit up from 205,000 the week before, but a bit below what economists had been forecasting at 210,000. And again, just a bit more of this back and forth of data out of the labour market, but overall conditions are still tight and it's still holding up pretty good. So first, let's talk about the elephant in the room. The 10-year Treasury yield actually slipped a little bit today, probably in a bit of a reaction to those jobless claims, as we saw some similar price action in Fed fund futures as well, which actually increased the probability the Fed will stay on hold now. Currently only a 29% chance they think they'll hike in December. However, with yields ripping higher, the market's kind of doing the Fed's job for it, because that's going to cool economic activity. And in my opinion, the Fed's kind of already on hold. They just don't want to officially announce that to the market. So I would be very surprised if the Fed did hike again in December, and I think they very much would like to have already reached their terminal rate for this cycle and kind of just let those 11 hikes since March last year just play out through the economy. And so we're already seeing the carnage in the bond market, with bonds now being in the worst drawdown in history. If you bought 10-year bonds just a couple of years ago in 2020, they're now worth 45 cents on the dollar if you were to sell them at market. And just looking at the price action in the 10-year yield today, just like stock markets, it was pretty flat, low volatility. And I'd say traders are just on the sidelines waiting for that non-farm payrolls report tomorrow, where we could get a big move in both stocks and bonds out of that. So right now it's still too early to call a top. On yields, we could easily see 5% on the 10-year in the coming weeks still. And so the Fed is likely on pause and inflation has been ticking down. So you may be wondering, why are yields ripping so much higher? And I'd say part of that is the market's focus now on government deficits, the huge amount of debt they have, and now the huge cost to service that debt, in addition to all the new debt they have to sell over the next year. And since the government sells a lot of their debt in long durations like 5-year, 7-year, 10-year, even up to the 30-year, that's why we're seeing the back end of the Treasury curve rise a lot faster than the short end, which is controlled by the Fed, because the Fed is most likely on pause now. And that's why we've got those yield curves steepening back to break even as well. And since the clowns in Washington continually flirt with shutdowns and hitting the debt ceiling and constant gridlock, there's a real risk for the markets out there that Moody's could join S&P and Fitch in downgrading the US credit rating. And that would be the third and last of the big credit rating agencies to do it. And the last two times we saw that happen, US stocks sold off pretty hard and sharp. And even though this doesn't have an immediate or material effect on the US government's ability to borrow or repay its debt, it isn't a move in the right direction long term, and just adds further upside pressure to yields, because the lower a borrower's credit rating, the higher the rate they have to pay to attract capital. And there's a lot of flow-on effects with what's going on in the yield market, as it affects just about everything. And one of those markets we're seeing immediately affected is that of mortgage rates. They're climbing really fast, now sitting around 7.5%, and could potentially hit 8% by the end of the month. And that's making it very hard for people wanting to enter the market for the first time. And that's why we're seeing home loan applications sink to the lowest levels since the 1990s. And this is a similar story in all Western markets around the world. And while we have seen some weakness in prices due to the lack of inventory, we haven't seen those big crashes in property markets just yet. But looking at valuations, the ingredients are there for a property crash, or decent sized correction at the least. And the higher cost of borrowing just increases the chances the US will go into a recession, just as respected economist Mohamed El-Erian says. Even though the Fed's only put the chance of a recession happening by September next year at 56%, I think that number's more closer to 70 or 80%. But of course, the Fed doesn't want to spook the market by saying anything too dire like that. But it'll be a true miracle, and like the first time in history, the Fed's done an aggressive rate hiking cycle, in addition to the highest inflation in decades, that the US could avoid a recession. It's possible, it's just not probable. And this is even if we don't see a material uptick in inflation again like we got in the 70s, when oil exploded higher on the back of the oil embargo when the Saudis stopped sending oil over to the States. And so while oil has been ripping high these last couple of months, we saw a bit of a pullback again today, following data yesterday that the amount of gasoline inventory in the States spiked a bit higher, showing that these recently high prices are already affecting demand at the pump. And I'd say the Saudis and the Russians are likely to come out with commentary, as they probably want to keep oil below $100 a barrel, probably more around $85 a barrel. And just looking at the daily chart of crude oil futures, we're a bit below that level, sitting right at the bottom of this support zone, which was a previous resistance zone, just looking back out in history, where the market's turned a few times. And so it's getting a little bit technically oversold here. However, I would expect it to be supported around $80 a barrel and potentially just go into a bit of a sideways consolidation pattern for a few months. So we can all look forward to paying a little bit less at the pump over the coming weeks, and that should help keep a lid on inflation for now as well. And that recent sharp sell-off in utility stocks is causing some analysts to say close your eyes and buy them, because the overall sector ETF is now yielding a dividend of 3.8%, with them saying the recent sell-off has created sufficient valuation dislocations that investors can benefit from. And it has been quite the sell-off in utilities this year, the second worst performing sector after regional banks. However, utility stocks correlate really highly with yields at the moment. So when you're buying utility stocks, you're kind of also making a bet on interest rates. That is, if you want utility stocks to go up, you kind of need interest rates to drop as well. And so while we are technically oversold here on the utilities ETF in the short term and very likely to get a bounce soon, the dividend yield at 3.7% is still a bit below what you can get risk-free from the US government in a one-year government bond at 5.38%. And just looking at a clean monthly chart of the utilities sector fund ETF, it is getting pretty oversold on the longer time frame as well. However, I wouldn't call it really good value until that dividend yield starts approaching the same level we see in government bonds. And for that to happen, it would have to trade below $50 a unit. So things could still get worse yet in the utility sector, especially if we don't get a pullback in rates anytime soon. And you may have seen today the shares of Coca-Cola and Pepsi getting absolutely slammed, both down around 5%, which is a huge move for the normally low volatile stocks. You can see that on the daily chart here. This stock normally moves like an elephant, but got absolutely whacked today along with Pepsi in very similar price action. And Pepsi's actually got earnings coming out in 4 days. And why I think that's happening is we could be seeing a material shift in the market for cheap sugary snacks, because like a Walmart executive said yesterday, that new blockbuster weight loss drug Ozempic could be actually impacting food sales they're seeing in their own sales. And so this is kind of a game changer in the weight loss market, and so far has shown really good results in helping to suppress people's appetite. And so it's just kind of funny to see it's already having a material impact on the companies that sell those cheap sugary snacks, as it's those products that are the largest contributor to obesity, which is the real pandemic in Western society, that has a much larger material effect on the average person's health and the healthcare system at whole compared to COVID. So wouldn't it be nice if governments gave out this weight loss drug for free, just like they do COVID vaccinations? However, that's a story for another day. And even after that sell-off, Coke is still showing as overvalued on my stock fair value indicator. And I know this is one of Warren Buffett's longest held positions, as he started accumulating shares for Berkshire back in the 80s. However, long term, I don't really like Coca-Cola, and others like Pepsi as well, still showing overvalued, because they're some of the largest contributors to obesity, which is a huge problem in our society. And sure, they're trying to adapt with more healthier products. However, their companies are built on cheap sugary snacks, so that's kind of hard to get away from completely. And I'd say that secular trend and society slowly waking up to the harmful side effects of their products is going to keep a huge headwind and downside pressure on their profits and stock prices going forward. So they're not for me. The market's still on shaky ground. We can see that in the fear and greed index in the extreme fear zone. And just something different in this sell-off in the market is normally when the market sell-offs, you'll see corporate insiders increase their buys as they often buy the dip. However, looking at yesterday's data, we recorded 182 corporate insiders selling stock versus 45 purchasing stock. And that's really surprising to see them increase their selling when the market is dipping. And even though the market is technically oversold, as we can see in my indicators here, dark pool percentage and S&P 500 oscillator, we are due a short-term bounce. I still think the floor could fall out from underneath the market here a bit as we're calling up going into NFP tomorrow. And that's because I can see on my DSI and hidden divergence indicators here, we're just really not getting that divergence. It's on the S&P 500 kind of flat. The Nasdaq's holding up a bit better. We are getting a little bit of divergences there. However, looking at the Dow, that's actually still pointing down. Mid-cap's flat and pointing down a little bit, and the Russell still flat and pointing down on my divergence indicators, which is saying we're not really setting up a strong bottom just yet. We are getting that signs of increased volume and are technically oversold. However, like I've been saying, I wouldn't be surprised if we get that big flush still, and especially going into the weekend on an NFP, we can often see those big sell-off days on Friday. And we've still got the VIX at 18.5. And to have a good flush, we want to see that spike above 25.30. So we may see it come tomorrow, especially if non-farm payrolls come in stronger than expected, sending yields ripping. And going into a weekend, that could be a good reason for the stock market to come off a bit. And the market's just pricing in a bit of volatility tomorrow. We can see that in the VIX one-day index at 19.5, which is a bit above the 9-day at 18.3. There's a look at international stock indices, trying to find a bottom down here as well. There's China stalling out, the Nikkei was flat, and a little bit of a bump up in the support zone on the Aussie 200, back to where it bottomed in middle of March. Bond market volatility still elevated with the MOVE index at 130, and it was a pretty quiet day in the options market, only 34.3 million contracts traded, showing that the market's kind of really on the sidelines going into NFP tomorrow, and it was equal amount of puts and calls traded, and just still not seeing that big pop up in breadth. It's kind of staying really suppressed down here, and the amount of stocks hitting new lows versus new highs continues to accelerate, but mega cap tech is still holding up the indices. We can see that in the growth offensive sector spread, and we've actually got Nasdaq versus Russell small cap stocks currently sitting at all-time highs. And there's a look at the 10-year versus 2-year yield curve, and that really sharp steepening we've seen over the last couple of weeks. And there's the short end of the curve coming off a little bit the last couple of days. Still above 5% on the 2-year, but we can see out the back on the 10-year and the 30-year still holding up a lot stronger. There's TLT calling up on low volatility as well. We're also not seeing the best of divergences in this market, even though we're really oversold down here. And there's high yield bonds just trading up a little bit today, and the dollar pulling back a little bit, and the commodity index now into a technically oversold area. Gold as well, trying to find support here at 18.30 an ounce. Natural gas has popped up as we're going into the cooler months in the northern hemisphere, and there's uranium trying to find support after having a bit of a multi-day pullback. And you're going to be paying more for your orange juice soon. That just broke out to another all-time high. And over to stock sectors. Let's start out by taking a look at my sector trends table indicator. And you can see here we've got every single sector below their 20-day and 50-day moving average, showing there is a bit of downside momentum across the market. However, we've got almost half of all sectors above their 5-day, showing that it has been stalling out a bit, is trying to put in a short-term bottom. And we've got a bit more than half of sectors below their long-term 200-day moving averages. There's the cannabis ETF MSOS continuing to pull back here. Looks to have recently just lost that resistance zone where it had previously turned before, and we'll be looking for that next resistance zone around 640, 650 to become support. There's clean energy coming off another 2.8% today, and there's retail stocks actually finding new multi-month lows. Industrial stocks still weak. Financials having a bit of a bump up today along with regional banks. Energy, oil and gas now technically oversold, trying to find support, and REITs actually traded up a bit higher. The winner today was biotech, up 3.2%, and got a little bit of a bump up in healthcare, but there's that staples sector coming off hard with Coke and Pepsi. And there's utilities calling up as well. There's Apple actually reclaiming that support zone, and mega cap tech is just continuing to prove resilient in this market and is holding up a lot better than the rest of the market again. And there's Microsoft on a bit of a divergence. Google holding up good above its 50-day. There's Amazon and NVDA still trading pretty good, along with the other big guy, Tesla. Over to the meme space, was a bit mixed out there today. Did see the EV makers come off a bit. Also active today was Staples Clorox company, coming off 5.5% after announcing there had been cyber attack. And General Motors had to do a big recall for a faulty airbag. And this is just another one of these old economy stocks. When looking at a monthly chart, it's just done nothing for over a decade now, basically gone sideways. And of course, Tesla's been eating their lunch for the last couple of years. But I think the market has thrown out the baby with the bathwater on this one as well. And we can see my stock fair value indicator's got it way undervalued by 81%. And this is still a cash cow. It's actually produced about $8 in earnings per share over the last year. And the stock's just priced at $30. So even if we get no growth from the stock, you'll get all your money back in the next 4 years in earnings yield, and a stock that doesn't grow still increases its book value over time from retained earnings. And looking at this candle we got today on big volume, this could be a bit of a reversal candle, maybe hitting a bit of a low here. And just like these other old economy stocks, Walgreens, I think they're pretty cheap, and they've been largely ignored by the market over the last couple of years due to most of the market being focused on mega cap tech and cloud stocks. And just like 3M, which I think could be starting to get cheap, still could go a bit lower here. And similar story on Ford as well. I think long term these levels could represent bargains, because like I said, even if they don't grow their earnings much at current valuations, it won't take long to get your money back in earnings yield. Another stock I'm interested in at the moment, Sphere Entertainment, which is the owner of that new Sphere in Vegas. They were actually Madison Square Garden Company, and they renamed themselves to Sphere Entertainment. And they had the U2 concert in there recently, which went really well. And since they've pulled it off once, they could pull it off again in other cities around the world and kind of let artists do tours in all the spheres and other things like that. So I think this is an interesting stock long term, and it actually pulled back 6.5% today. And since my stock fair value indicator looks at forward earnings projections, it's actually got it undervalued by 36%. And if you're interested in getting lifetime access to my stock fair value indicator, just come to my website, clickcapital.io, head on over to the indicators page, and scroll down to the description of stock fair value, where you can buy it and get it added to your TradingView account today for the one-time fee of $99. And this is one of my most used indicators. It works on every stock around the world, no matter where you are. America, Canada, UK, France, Germany, Australia, Singapore. It works on every single stock, and it's according to my unique formula that gives you what I think is a fair price for each stock. And so basically my investing strategy is to buy good stocks that are deeply undervalued and to short low quality stock that are significantly overvalued. And I rely on this indicator to kind of do all the heavy lifting for me, so I don't have to pore over balance sheets and income statements. I can just quickly look and see immediately whether the stock is undervalued or not. Moving on, other stocks we follow: AT&T, Verizon, more deeply undervalued old economy stocks, currently sitting at support here on Verizon. From when we initially dipped after that report of all those lead cables they have to fix, and that too is another deeply undervalued stock, which made around $6.50 in earnings over the last year versus a $31 stock price. Pretty good value. Going out to the regional banks, we got that little bump up today, but they're still on downtrends, just like the big guys who are trying to find support here. Okay, back to the S&P 500 to wrap it up. We're sitting right at that trend line again, coiling up, waiting for that non-farm payrolls tomorrow. We could get that big flush out tomorrow, and as the days go on and we don't get that bounce, that's kind of increasing the chance that we may get another flush out. And like I said, my indicators are not really showing a divergence here on the S&P 500 and the other indices, all except tech, which is actually holding up the best, with Apple reclaiming that support zone. But indices like the Russell 2000 and the Equal Weight 500 just continually look a bit weak here, and so we could still be in a bit of a slide. And with the VIX under 20, it's still very possible we get that flush out before we put in a short-term bottom. So we'll just have to wait until tomorrow morning when we get those non-farm payrolls, with the economy expected to have generated 170,000 new jobs. That comes in a bit higher. I think the market is going to sell off and yields are going to rip again. So it could be an interesting day. And that's it for today. Thanks very much for tuning in, and come back to the Click Capital channel tomorrow, where I'll dive into the non-farm payroll and the market's reaction to that. All right, guys, see you then.